Hello friends, this is Ghalib Moideen and welcome to my new video blog. From today we are starting a new series on accountancy and we will be covering all the basic things in accountancy from scratch. So this video is for those who are starting to learn accountancy, those who are that can be in +1, +2, your degree or any courses that requires accountancy knowledge, and this is also intended for persons who are willing to study accountancy and does not have a base, say like the students who have studied science and who are now pursuing some course in commerce and needs a basic understanding in accountancy. So let's start our new session on this accountancy. First of all, what is accountancy? Accountancy is the process of accounting all the transactions that is related to a business and finally arriving at the position of the business. That is like if a business is running, the accountancy means that the importance of accountancy is that the accountancy after accounting tells that this is a profit that your company has during a year and these are the liabilities or these are the assets of the company after functioning for a certain period. So this accountancy is basically built on many concepts and this understanding of these concepts are very important. So our first day session will be on concepts of accountancy. These concepts are very much base of accountancy, and if your concepts are very much concrete, you can study up to any level that you wish to study. That is even till your PG. So accountancy, concepts of accountancy is like base of a building, and if the base is strong, you can construct any number of level building. Like that, if the concepts are very strong, that understanding of concepts are very strong, you can go to any level of accountancy course. So let's start our session. The first concept that we are going to learn is about business entity concept. This is a concept whereby the owner and business are separate entities. Let's see an example first and we will explain. This is a person X who has started a business by investing his hard-earned money into the business. Even though this is his hard-earned money, okay, even though this is his hard-earned money, accountancy states that the concept of business entity concept states that this business and Mr. X are two different entities. Even though his money is invested into the business, it is considered as capital of the business, which means that this amount is payable by business to Mr. X at any point of time. Okay, so this is considered as capital of the business. Okay, so business entity concepts, I will be repeating it 1 or 2 times because these concepts need to be having a very much concrete effect in your mind. So this concept states that the owner of the business is having a distinct entity than the business. So what all are we are accounting will be from the perspective of the business and not from the perspective of the owner. That is why the amount that is brought in by Mr. X in the business will be known as capital, and capital is the liability of the business to be paid back to the owner at any point of time. So the journal entry, we will be discussing detailed how to write the journal entry, how to form a journal entry in our 3rd or 4th session. So for the time being, the journal entry for accounting our capital brought in by Mr. X will be cash account debtor to capital account. We'll be understanding more detailed about these journal entries in later stage. Don't get worried about the journal entry that I have stated right now. So second concept that we'll be learning is the money measurement concept. The money measurement concept states that we'll be recording only we will be recording the transaction that only involves cash in the transaction and no other transaction of the businesses which does not have any impact on the money or the cash will be recorded in the books of accounts. Let's understand this by going through few examples. That is, first example is that the business has purchased a factory land worth rupees 1 crore. This is a transaction obviously including cash or money, and this has a place in the books of accounts. So this will be accounted for. Second is appointment of a factory manager. As such, directly there is no link to the cash or money where we are when we are appointing a factory manager. Obviously there is a impact when we are paying salary to them, but basically this appointment of the factory manager will not have a direct impact on the financials, and therefore we won't be recording it in the books of accounts. Okay, the third concept that one should be understanding is about the going concern concept. Going concern concept is the concept stating that the business will not stop its functioning in the foreseeable future. That is, the business that we are starting, or this business that has the company has started, will not be winded up in the foreseeable future. Example, this concept is very important because this is a concept on which many transactions are relied upon. Example, let me briefly tell you what a depreciation is. Depreciation means when an asset is purchased, and purchasing of asset involves mostly involves huge amount of cash. An asset is something, we will be studying what an asset is, but asset is something, I will just explain what an asset is. An asset is something that involves huge amount of money, and this asset will be giving a service for more than one or more than a year. That is, example, when we purchase a machinery, the service of the machinery will be available for the company throughout the lifespan of that company. In this example, let's assume that the cost of machinery is 6 lakhs and the life of machinery is 6 years. To make it simple, we will have a simple example. So in this case, in the year of purchase, we won't be expensing the whole 6 lakhs into the profit and loss account, because the service of this machinery is available throughout the period of this, life of this machinery. So by adopting two concepts, that is going concern concept, assuming that the near future we won't be stopping the business, we will be only dividing a portion of the cost of the machine to the profit and loss account. That is, in this case, 6 lakhs divided by 6 years will be 1 lakh rupees, and this 1 lakh rupee will be debited in the first year, 1 lakh in the second year, and so on and so forth till the 6th year. So going concern concept is the basic concept we are relying upon while debiting, that is while charging this cost proportionately to the books of accounts. So the next concept that we will be looking into will be the accounting period concept. So first we talked about what is a financial statement. Basic intention of this financial statement, that is basic intention of this accounting, is to form a financial statement. The basic intention of this financial statement, let's understand what all statements are financial statements. 3 statements totally is said as financial statement. 1 is the profit and loss account, 2 is the balance sheet, and 3 is the cash flow. This profit and loss account is prepared for a period, and this profit and loss account states that this much is the profit or this much is the loss during this particular period, and balance sheet is prepared as on a date. So profit and loss account is for a period, balance sheet is as on a date, and the balance sheet is a statement which states that okay, these all are the assets and these all are the liabilities of your company as on a particular date. Cash flow is also prepared for a period, and cash flow is a statement whereby it states that okay, from these all sources you have received money, and these all are the sources for which the money has been spent, and this much is the balance in your hand. So these 3 statements together combined is called as financial statements, and these financial statements are prepared for a specific span of time, and this span of time is known as accounting period. Basically, a financial statement is prepared, or largely or mainly people prepare financial statement for a year, a financial year. A financial year typically comprises of 12 months starting from 1st of April in a year and ending in 31st March of the next year. That is a financial, let's say financial year 2021, which is running right now, will start on 1st of April 2020 and will be ending on 31st March 2021. So basically the I didn't say that accounting period is always a year. Accounting period is the span of time for which this financial statement is prepared. For example, a period of 3 months is an accounting period for listed companies to come out with a quarterly financial statement saying that I have been earning this much profit for the quarter, or this is my position of the company for this quarter ended on this date. A year starting from April to March is the financial year or the accounting period for which financial statements are required by all the tax authorities like income tax, GST, customs, etc. All these departments require a balance sheet, P&L, and a cash flow for the financial year, and that financial year is known as accounting period. Another accounting period is a period of 1 month for internal review meetings. Say the company will be assessing the performance of all the sales staff for on every month, and for that every month a financial statement is required showing that this is the sales that company has achieved for that month, and that is also known as, that is an accounting period. So accounting period does not have a specific period of time. Accounting period is a period for which this financial statements are made. So it can be a 1 month, it can be 3 months, it can be 12 months, or any other period as per the norms of the company. But for tax purposes or statutorily, for most of the laws in India requires a statement to be prepared, that is a balance sheet and P&L to be prepared for a financial year, and a financial year as discussed is from April of a year to the March of the next year. Next concept that we will be looking into will be the cost concepts. This is a concept whereby we are telling that, or we are having a concept whereby accounting of a transaction will be done on a cost basis. Say if an asset is purchased, that asset will be booked in the books of accounts or recorded in the books of accounts by including all the purchase cost, the transportation cost, installation cost, and other costs which forms part of putting the asset or making the asset workable for the company. Okay, so as the cost concept says that we will be accounting in cost and not in any other basis. That is, once an asset, say if I am purchasing a property or a land for my factory in Bombay for rupees 25 crores, and after a year or two the cost of the land has increased to 37 crores, we won't be accounting, or we will not be making any entry in the books of accounts for bringing that market value of the land to our books of accounts. The cost concept states that in the books of accounts all the assets will be recorded only at cost, and we won't be making any changes or any entries for bringing in the effect of the market value. Okay, example, as I said, we bought a company or a land for 25 lakh. We won't be making any changes in the books of accounts for the variation in the market price after the purchase date. So we will be carrying all the assets in the historic cost in our books of account. Historic cost means the cost at which we have acquired the asset. So the cost concept is also very simple concept. You will be recording it in the books of accounts. Assets will be recorded in the books of accounts for the cost and not at the market prices. Next concept that we will be covering is dual aspect concept, and this is the most, I would say, the most important concept in the concept section, because this states that every transaction will be having effect in two accounts. That is, every transaction will have two impact in two accounts, accounting book. So let's understand that through an example. Mr. X, as always, Mr. X started a business by investing a certain amount in a company, and as stated before, this will be known as the capital of the company. Okay, so this transaction has this transaction has effect on two accounts. That will be on a capital, that is a liability. Capital, as discussed, the amount that is put in by the owner will be shown as a liability to be paid back to the owner by the business. So in the point of view of the business, when a person or when the owner puts in money to the company, there are two effects. One is that the liability, which in turn is a capital, will increase on one side, and other side, cash, which is an asset, will also increase. That is, say the company is having 0 tallied. Okay, the owner is bringing in money, so the money portion will increase, which is in the asset side, because money is an asset. We will have an increase in the cash part, and also capital will also increase, whereby the amount is to be paid back to the owner of the company. So always there will be a dual effect in the books of accounts. We won't be when we are making an entry in the books of accounts, two ledgers will be affected. We'll learn what a ledger is, but two ledgers will be affected. The next concept that we will be going through is the revenue recognition concept. Revenue recognition concept states that an amount will be booked in our books of accounts as an income only when it is realized or when it is realizable. That is, I would say, when a person is selling, when a person is involved in the sales of goods, say a hypermarket, a supermarket, the supermarket will only recognize the amount as revenue or sales in the books of accounts when they won't account it as a sale when they have purchased the goods. Or say I am entering a supermarket with a trolley and I'm taking many things. They won't account it as a sale. They will only account it as a sale when they have billed it to me and I have a right over the goods that I have put in my trolley. So the revenue will be booked only when it is realized or realizable, and in case of when a person is involved in the sale of a product, the person can record it as a sale only when the goods is transferred to the person who is buying it. So realized means when I bought something, I have paid the money, means the company has received money, and that receiving is meant as realized. That is, when a money is received for a product, against a product, it is known as realized. Now realizable means the company has right over the person to ask for money. That is, I would say, when I purchase something from a store, that store, and I have not paid the money, the store has a right to catch my collar and ask for the money. That's why I have put a collar picture there. That means the store has the right to ask money from me. So that means it is not realized. That is, I have made the sale, but the company has made the sale, but company has not realized the money, but company has acquired a right to catch the collar of the debtor and ask for the money. So the concept basically states that revenue can be recognized. That is, one should only record a revenue. Revenue means income of the company. So the one can only recognize the revenue, that is income, in the books of accounts only when the person has realized the money, or person has when a money amount is realizable. Example, a sale transaction can be recorded when the product is given to the customer and customer is liable to pay you the money. As I said, if you have given a bill, but I would say where the importance is. If you have given a building on rent, then the rent revenue shall only be accounted on the months on which the rent is due and not for the future rent receivable. Example, I will illustrate that. Okay, I have given a building for rent for rupees 1 lakh per month. Okay, in that case, today I am entering into contract with my tenant saying that okay, you can take this building for 1 year for a monthly rent of rupees 1 lakh. Then I won't be recording this 1 into 12 months, that is 1 lakh into 12 months, which is 12 lakh as revenue for me today, but I would be recognizing 1 lakh every month after I have given, after he has utilized my service, that is service of my using the building. So this is the importance of revenue recognition. We will be only recording the revenue in the books of accounts when it is due to us, whether when we have realized or when it is realizable, when we have a right to realize the amount. So when I am entering into the rent agreement, I won't be recording the whole rent as income for today, but I will be recording it partially as and when the service is completed and I have the right to ask for the rent. Now the totally, if you are getting bored, I would like to say that okay, we are having totally about 13 concepts. This is only the 8th concept, so if you are bored, you can take a break. If you're enjoying the lecture and somewhat you are feeling that okay, it is going above your head, you can pause the video and come back after taking a short break. So we will be going to the 8th concept, that is the matching concept. Revenue and expenses should match for the period. This concept simply states that if a revenue is realized or realizable, as discussed in the previous concept, should be booked as revenue. That is, I would say that P&L. P&L is the statement where we are showing that okay, this is the expense and this is the income for the particular period as discussed earlier. So a revenue or expense will be booked in P&L. P&L is the asset for that period. In P&L, if that is for this period, okay, that is revenue or the expense will be recognized when the money is due. I would explain it in a better way. Okay, say this example is a good example. Okay, if insurance premium is paid for 2 years for insuring a factory building, then first year premium should be recognized now and second year amount should be treated as prepaid insurance, which is a current asset, which means that okay, I bought a factory building. I'm insuring that factory building against a fire accident, and I am paying the premium amount for 2 years, for this year and for the coming year. So it is not right from my part to account the whole premium as expense in the books of accounts for this year. Instead, I would be only recognizing, say if 20,000 is the premium for 2 years, I would be only recognizing 10,000 in this year, which for this year, and 10,000 will be recognized as asset. Okay, in this example, insurance is paid for 2 years, that is 55,000, 30,000 for the first year and 25,000 for the second year. Okay, 30,000 will be treated as expense for this year because the P&L is for this year, and this P&L should include only expenses and revenues for this year. Matching concept is simple. It states that the expenses and the revenues that you are showing in P&L should relate to this period. So if 30,000 is for this year, 30,000 will be treated as will be shown as expense in P&L, and 25,000 will be shown as an asset, because asset, why it is an asset means we have paid in advance for something that is receivable. That means we are having an asset. We have an asset means we have a right to ask the insurance company in the next year to provide us this service. So we are having an asset, which is the prepaid insurance. So the matching concept simply states that you should only account for account as an expense or an income if it is that relates to that particular area. I'll give you a different example. The company sold a product for 50,000 in this year. They should account it as income for that year, even though the company has not received that 50,000 from its customer. Okay, because he has acquired a right to ask for that money, as said in the previous concept. So, and when the money of 50,000 is received in the next year, he should not account it as an income in the P&L, because it is not related to that year. Instead, it is related to the previous year in which the sale was made, and that is to be treated differently as a receipt from the person who owes the business the money. I hope it is clear. Otherwise, hang on. We will get a detailed analysis in coming chapters. Okay, and if there is if there is any doubt, you can definitely ask in the comment section, and I will be coming up with the answers. Okay, so the next concept that we are going to cover is the full disclosure concept. All material and relevant facts concerning the performance of a business should be fully and completely disclosed in the financial statement and accompanying note for the stakeholders to take an informed decision. Basically, we are preparing this balance sheet, okay, for many persons. Maybe for the owner of the company to know that, okay, what is his assets, what is his liability, what is his profit, or what is his loss. For the employee to analyze, if a factory manager is being employed, saying that I will give you 50,000 rupees as salary and 2% on the sales amount of the company, the employee is interested to know interested to read the financial statement, because he wants to calculate his income based on the financial statements of the company. Or let's say the tax authorities are interested, because tax authorities charge tax on the income of the company, and the company's income is derived from the financial statement. So this financial statement is an interest topic for the tax department. Or for the shareholder, if I am a shareholder of the company, I'm definitely interested to know that, okay, what is the profit? Should I be holding the share, or should I just sell off the share so that I don't incur any losses in future? Or say a bank is lending some money to the company, so the bank is interested to know the financial statement to understand that whether the company will be able to repay the amount to the company, or will he be turning to another Nirav Modi or Vijay Mallya, whereby the bank loses the money which it gave to the borrower. So the bank is also interested to know that, okay, what is the position in the finance statement. So the full disclosure concept states that the statement the company should disclose all the relevant information in the financial statements and accompanying footnote. Footnote is the part of the financial statement, but is not included in the balance sheet or P&L. It comes as a disclosure in the balance sheet and P&L, whereby many facts are disclosed which has an impact on the finance statement. Example, if the company is facing a case related to its right on its brand, say Coca-Cola is facing I have filed a case against Coca-Cola stating that, okay, I have the right over the brand name Coca-Cola and not the Coca-Cola company. Then it is an important event which is to be mentioned in the footnote, whereby the company, the persons who are interested in the company will be knowing that, okay, there is a risk or such a risk existing in the company. Example, we will see another example. The entity has say ITC has many products. Many products means many products. They have cigarettes, they have FMCG, they have food products, many things. Okay, say for making it simple, we will say that, okay, they are having soaps, such things. They are having cigarettes, and they are having other food products. And say, let's assume that the cigarette is the biggest revenue point for them, and I am investing in a company, seeing the revenue of seeing the profit of the company. And in this year, the company has decided to wind up its cigarette business and only to continue with those other food and FMCG soap like things. Then this is an important, even though the company is not winding up, this is an important event which has an impact, very big impact on the financial statement, and this information should be mentioned in the footnote stating that, okay, the company has decided to shut down its cigarette business. So the full disclosure concept states that all the important things that affects the operations of the company, that affects the financial statement of the company, should be mentioned in the financial statements and accompanying footnote. Okay, now next concept is consistency concept. Consistency concept is that many policies will be adopted by the company for recording the things in books of accounts. Okay, we'll discuss one policy in the coming example. That is, if an investor wants to compare the and what is the importance is that if someone wants to compare the financial statements and the policies are not adopted consistently over the years, there will be a difference in the P&L. We will understand by the illustration. That is, a company has purchased a good, okay, and the machinery, and the cost of machinery is 10 lakhs, and the life of machinery was estimated to be 10 years, and for the same reason the company is in a process of expensing rupees 1 lakh per year in the P&L as expense. As discussed in the previous concept, the company should not expense the full asset value to the P&L. Instead, we will be only debiting that, or we will be only charging proportionately based on the life of the asset. And in this case, this crane of rupees 10 lakhs has a life of 10 years, and eventually the company is in the practice of charging rupees 1 lakh to the company's profit and loss account. Suddenly, the next year the company assumed that the life of the machine is 20 years, and hence only 50,000 needs to be charged the P&L, which means that if everything goes same as the previous year, even though if everything goes same as the previous year, due to this concept change, due to this inconsistency in providing the amount of machinery to the P&L, there will be a difference of rupees 50,000, because last year we charged 1 lakh, and the same amount we was to be charging this year, but we are only charging 50,000, and that means there is an inconsistency. And for the same reason, one person will not be able to come to a correct conclusion by comparing the financial statements, because the principle that is adopted by the company is not consistent over the years. So the consistency concept states that the assumptions, the policies that is adopted by the company should be adopted throughout the years and should not vary in very frequently over the years. Even though there is a change due to genuine reason, we should disclose it. We will study it, how to disclose what are the changes to be made in the financials based on if there is a genuine change in the accounting policies adopted by the company. Now we are having 3 more concepts. I hope everybody is with me. Next concept, that if you are finding it understandable but having going it over the head because of this lengthy video, you can definitely pause the video, take a break, have refresh, and come back and learn the concept. We will be having 3 more concepts, and the 11th concept will be concept of prudence. Profit should be booked only after realizing it, but expense should be booked even if there is a remote possibility of incurring the same. This is like this. I would say, while accounting, okay, we will be choosing a conservative approach. That is, if the profit is going to come or it may come, we won't have any, we won't take it into consideration. It won't have any impact on the books of accounts. But if there is a chance that an expense will be incurred, or amount is to be paid for any expense, in such case we will be accounting for the expense. Example, valuation of closing stock is done. Okay, let's understand how closing stock is valued. Okay, closing stock means we have purchased so many goods for sale tomorrow, okay, in future, and after selling many things, we are in the end of the accounting period, we are left with so many goods which we will be selling in the next year or the next accounting period. So at the end of that accounting period, we should be valuing, okay, we should find out because in the as discussed in the previous concept, the books of accounts or accounting will only have the money part. So we don't need, okay, I have this much unit of products in my godown. Instead, we need, okay, this is the value of goods that is lying in our godown. So while arriving at the value of the closing stock, which is the stock that is lying in our factory, which is to be sold in the next accounting period, we will be valuing it at cost or the realizable value, whichever is lower. Say I have purchased 10 number of X good for sale for rupees 1 lakh each, okay, and its sale value was rupees 2 lakh or 1,50,000 when I was buying it, and by the end of the accounting period the value, the sale price of this good has reduced to 75,000 rupees, and what amount I have purchased it at 1 lakh rupees. That means that I will not be getting rupees 1 lakh, even 1 lakh on the date of sale. So in that case I will be incurring, when I am selling, okay, 1 lakh, I purchased the good for 1 lakh, and when I am selling it for 75,000, I am incurring a loss of 25,000 rupees. And on the date of this accounting period, I am pretty sure that, okay, I won't get 1 lakh, but I will only be getting 75,000. So the net realizable value means today if I sell this, what is the amount that I will get? And that is 75,000. So always the closing stock will be valued at the amount at which we purchased or amount that we will get on the date of accounting period ending, the amount that we will get on the sale, and whichever is lower. So in this example, 1 lakh is a purchase cost. Even though 1 lakh is a purchase cost, when we sell, we will only get 75,000 rupees. That means that we will be recording the goods only at 75,000 rupees. So the concept of prudence states that, okay, we won't be accounting for future profits, whereas we will be accounting for future losses. So let's see one more example. Cost of purchase was rupees 1 lakh. Market price on the date of the date on which we are making the balance sheet is rupees 90,000. That means 10,000 is gone. We won't get it. So that 10,000 loss is to be recognized now, whereby we will be only recognizing the closing stock at 90,000. But if the case was like this, we purchased it for 1 lakh, and on the date of we are making the balance sheet, the sale prices, or when we sell it, if we are getting 1,20,000 rupees, we won't record the 20,000 profit, whereas we will be only recording it at 1 lakh rupees itself. That is the cost of prudence, whereby future profits won't be recognized, only future losses and expenses will be recognized while making a financial statement. So the next concept is materiality concept. Materiality concept is that we should only discuss or we should only disclose factor. We should fully disclose, fully record the transaction, and make a point that each transaction which involves money should be there in the balance sheet. But special disclosure is only required if that has a very important that has a very much importance while the user of the balance sheet sees it. For example, a company purchased new office building worth rupees 1 crore in Andheri, okay, then that has a very importance while making a decision. So that is to be disclosed separately in the balance sheet or the financial statement. That may be P&L, that may be balance sheet, okay. So in the financial statements, okay, we should state that, okay, this is a big transaction and this needs the attention of the person who is using the financial statement. So you should be mentioning it separately. But say regularly we are purchasing office stationery like pen, pencil, paper, toner, everything. That does not have required to be disclosed separately, because the user, the reader of the financial statement does not have anything to do with the regular expenses or regular stationery purchase of the company. So the materiality concept states that anything that has an importance, anything that has an impact on the decision making, or anything that has an impact for the user of the financial statement, that is to be disclosed separately. And if does not have that is of a meager value, or that does not have a impact, that does not have any effect on the decision of the user, then that does not need to be disclosed separately. I again repeat it, we need to account it, but disclosure, say we should not the balance sheet, the P&L should not tell that, okay, I have bought one pen for rupees 10. No, that is not important. But I have bought 1 crore rupee building is an important message, and that is to be communicated separately. So that is the materiality concept. Now let's understand the objectivity concept. Accounting should be one in an objective manner. This can be done by verifiable documents or purchase vouchers. That is accountancy. Once I am an accountant in a company, if I am an accountant in a company and I am recording something in my books of accounts, that is to be supported by many documents. If I say that, okay, I have incurred an expense of rupees 1 lakh as salary, I should have a record proving that I have paid the salary. If I am recording that I have made a sale and it is 1 lakh, I should have a record stating that this is, the sale amount is only 1 lakh and not 1,50,000. Okay, so a purchase entry should be supported by invoice, bill of entry, cash voucher, etc. I would explain that. Okay, if I am making a purchase, that if I am making a purchase and I am making an entry that okay, I bought something for rupees 50,000, that entry should be supported by the bill of the material that I have purchased. The bill of entry or it means that okay, that has come to the factory or that has come to India. If I'm importing it, okay, it has come to the bill of entry is a document that is issued by customs stating that okay, this good have entered the Indian territory and this is the amount of tax that is still paid as import duty. That bill of entry. Cash voucher, the cash voucher proves that okay, I have paid the money in cash. The bank it's a copy of check, and such documents is very important document which proves that okay, I have recorded a transaction based on various documents. So in total we are completing the concept of accounting. We are having 13 concepts. I hope that the concepts were clear for you. The understanding of this concept is a very important factor, because if this is the concept, this is the base of accountancy, and these concepts has very much importance while studying how to have a journal entry, how to get your trial balance, P&L, balance sheet, cash flow, various things. So these concepts needs to be very important. If you have any doubt, you can comment. If you need more clarity, you can refer back to this video. We will be seeing in the next lecture. So thank you for the time being.